So today, we're going to put Arrow Electronics under the microscope. We're going to dig into the data and see what story the numbers really tell. And trust me, it all kicks off with one heck of a statistic.
So you might be asking, why Arrow Electronics? Well, it all boils down to this one number right here. Almost a 70% return on its stock just this year alone. I mean, a performance like that, you have to take a closer look. It's the perfect jumping-off point for our little investigation.
And that right there brings us to the big question, the main event of this whole thing. When you see a stock price just shoot for the moon like this, you gotta ask, right? Is the actual company, the business itself, keeping up? Or is there a big disconnect between the hype and the reality? Well, let's dig in and find out.
Okay, so first things first, we've got to take a closer look at this incredible stock performance. The momentum is just undeniable. But let's really break it down and see just how powerful it's been lately.
And what you're looking at here, folks, is pure acceleration. Think about it, almost 7% in just the last week, nearly 28% in the last month, and of course that monster 70% jump since January. Yeah, this is not a slow burn. This thing is a rocket launch.
And just to give you a little more perspective, the stock is trading right now just shy of its absolute peak for the entire year. It is literally knocking on the door of a new high. So this momentum isn't old news. It's happening as we speak. But, and this is a big but, momentum is only one piece of the puzzle.
Right. And this is where our investigation gets really interesting. This is where we start asking the tough questions. Can the company's actual fundamental growth justify that kind of explosion in its stock price?
And boom, here is the first major clue in our little mystery. Check this out. On one side, you've got the stock price growing by a blistering 72% in the last year. But on the other side, get this, the company's revenue over the last 3 years has actually shrunk by almost 6%. Now that is a major disconnect.
Oh, and the plot absolutely thickens. Look, the short-term picture for earnings per share, EPS, it looks fantastic. It's more than doubled in the last year. But once again, when we pull back, when we zoom out and look at the company's actual net income over the past 3 years, it's down by more than 26%. So what on earth is going on here?
Okay, so what we've got is a clear conflict in the data, right? The market is going wild, cheering for this spectacular recent earnings growth. But at the same time, the longer-term business fundamentals, well, they look like they're struggling. And that brings us to the really big question.
So if the stock price is way up here, but the long-term business growth is down there, then what is this company actually worth? This, my friends, is the heart of our investigation, the valuation mystery.
All right, to figure that out, we need to introduce a key idea. It's called fair value. Now, all this really is an estimate. It's an attempt to figure out what a stock should be worth based on the cash the business is expected to bring in down the road. It's kind of like a tool for looking past all the market noise and hype.
And here it is, the moment of truth. The market says the price is over $187, but a fair value calculation, based on those future cash flows we talked about, it comes out to just over $89. Wow, that is less than half the current trading price. We're talking about a massive, massive gap here. This is what investors call the margin of safety. It's basically just the difference between what something is worth and what you're paying for it. And a negative 110% margin of safety, whoa. That is a gigantic red flag. It's basically screaming that the stock might be extremely overvalued.
So that's it then, right? Case closed. The stock is just way, way too expensive. Well, not so fast. In the world of finance, it's almost never that simple. Let's bring in one more piece of evidence before we jump to any conclusions.
Okay, we're going to look at something called the PEG ratio. Now, this metric is pretty cool because it doesn't just look at the price. It compares the price to how fast the company's earnings are growing. And the general rule of thumb is that a low number, usually anything under 1, can be a sign that a stock is actually a bargain for how fast it's growing.
And would you look at that? Arrow's PEG ratio is just 0.35. That's way, way below that 1.0 benchmark we just talked about. This tells a completely different story from that fair value number. This number is suggesting the stock could actually be undervalued, not overvalued. How about that?
So now our investigation is, well, more complicated than ever, isn't it? We have the fair value metric screaming from the rooftops that the stock is overvalued, while the PEG ratio is over here whispering, hey, this could be a deal. The numbers are telling two completely different, conflicting stories.
You know, when the stories about growth and value are this confusing, it's always a good idea to pop the hood and check the engine. Is the company itself financially stable? Can it actually weather a storm if one comes along? Let's take a quick peek at its financial health.
Okay, we'll just look at two key numbers here. First, the debt-to-equity ratio. At 0.47, that's pretty low, which is good. It suggests their debt is very manageable. Then there's the current ratio. 1.36 basically means they have $1.36 in ready-to-go assets for every dollar they owe in the short term. Also a good sign. So what this tells us is that, hey, no matter how confusing all the other signals are, the company itself seems to be on pretty solid financial ground. It can handle its debt, it can pay its bills, and that's a really important piece of this whole puzzle.
All right, it's time. Let's bring all this evidence together. We've got the crazy momentum, the conflicting growth numbers, those contradictory valuation metrics, and underneath it all, a solid financial foundation. Let's lay it all out on the table and see if we can figure out the data's final verdict.
And this right here, this captures the dilemma perfectly. On one hand, you've got the bull case, the argument for the stock. You've got that insane momentum, the strong recent EPS growth, and that really attractive PEG ratio. But then there's the bear case, the argument against it, and it's just as compelling. You've got that big negative fair value margin, shrinking revenue over the long term, and even negative free cash flow. Two totally different worlds.
And you know, this might be the most important takeaway from this whole thing. Sometimes the data doesn't just hand you a simple buy or sell sign. It doesn't give you an easy answer. Instead, it gives you a puzzle full of conflicting clues. It tells a complex story, and there are good arguments on both sides. So, in a way, we're ending right back where we started, but with a much, much deeper understanding. The data has painted a picture of a company with just incredible short-term performance that's sitting on top of a much more challenged long-term foundation. And that, of course, leaves us with the ultimate question for anyone looking at this stuff. When the numbers are telling you two completely different stories, which one do you listen to?